Don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. Al, as we get into this next segment, we've been having a lot of people come to these investing classes, and they want to know more about retirement and retirement strategies or techniques that the institutions, or we'll call it the successful investors, utilize prior to retirement, but also during retirement. You can kind of do the same thing, but it's a little bit different on the style that you would do. Now, let's talk about first. We have, once you retire, that income stream is now gone. And we're seeing a lot of people want to understand how the institutions or the successful investors are creating income during retirement, so that way they can hopefully preserve that retirement. A lot of people want to leave legacies for their families. Sure. So how does the average investor utilize these markets to be like the institutions and create income like they do?
Well, I think number one, you have to ask yourself some questions. What's your plan right now? Is it to work the rest of your life? Is it to live off of Social Security? Or is it to build and grow a retirement savings account? You have to start with what you need in retirement. And that's something that a lot of people don't think about until it's too late. So start with that. What do you need in retirement? Where are you now? And what rate of return do you need to get to where you want to be in retirement? And unfortunately, most people are put into...
It's simple math.
Yeah,
right?
That's simple math. And there are... so there's software that you can use that will help you figure that out. But most people look at... A financial advisor will just look at what you have, the amount of money you have now, and they'll look at what they think is an average rate of return and then tell you what you can have in retirement and how long that's going to last. Instead of doing what we think is a better way, is identifying or deciding what you want it to look like in retirement. What do you want your retirement to look like? And then let's try to identify the rate of return you need to be able to get there. That's going to determine the strategies that you use. Unfortunately, most people are put into, I'm going to call it a cruise control, one-size-fits-all kind of retirement plan. That's the employer-sponsored retirement plans, which are typically 401ks or 403bs. And most people know very little about them. And think about it. We went from years ago having pension funds as the primary source of retirement money for people, plus Social Security, plus maybe a little bit of investment in a portfolio. Now pensions are gone. Yep. Social Security is minimal. Mm-hmm. And now your personal investments, maybe what's in your 401k, your 403b, or an investment account, that has taken over as a primary source of financial survival in retirement. But now the employee is actually managing their own retirement accounts, because in the 401ks, 403bs, for most people, there's very little guidance or very little help that you get. When companies got rid of their pension plans and went to 401ks, here's what they did, right? They put people into a class. They had mentors helping them, guide them, and assist them in their investment choices. They had training in different assets, using different strategies in down markets and sideways markets. Oh, wait a minute. That didn't happen. No. It's more like, here's a handful of mutual funds. You make the choice. You take all the responsibility. And that's one of the reasons we have a retirement crisis. So we talked about in that last segment, futures, Forex, and options. Those are assets that people can use in a self-directed retirement account. And that's what the institutions, that's what the pros are using. But again, they're putting most of their clients basically into a mutual fund type of a retirement plan.
Al, you had me confused there for a second. I thought you were losing your marbles there for a second. But, think about this. We had pension plans. There's a couple left, but there's not many people that have pensions anymore. Social Security is minimal. That's why it's so important. It's been put on us as investors to learn how to do that. And unfortunately, most people haven't taken that time to do that. Well, now is that time to learn the different techniques, the different strategies, because, there's no better time than now, and you are the best steward of your money. Al, you mentioned a term called self-directing. We have... a lot of people have IRAs, and we talked about the 401k, the company-sponsored plan. There's certain things you can and can't do with that. The great thing about having a IRA is you can self-direct it, which means you manage it. And there's a lot of people that want to be more comfortable but also confident making that step. So how does the average investor start getting into self-directing their portfolio, but how do they learn the right techniques and concepts as well?
Well, understand, I guess, accept the fact that you're right now you're managing your own portfolio anyways, whether it's a 401k or 403b. If you are making the choices, if you decide which mutual funds or ETFs to be in, and you decide which ones to rotate into, which is, my guess is that almost everybody listening, that's the situation, then you're already managing your own assets. A self-directed IRA is something that almost every brokerage firm will allow you to set up. One of the great things there is you eliminate fees.
That's that F word we do not like to hear.
See, the only F word we can talk about on the radio. Fees, and that's part of that cruise control one size fits all strategy. People just accept the fact that there are fees associated with it. Basically, you're paying somebody or a firm 2 or 3 or 4 or 5% just to hold your assets there while you make choices.
Think about that. People are spending money. Well, that's a lot in fees over a course of a lifetime. They think of it as 1 year, but that's a course of a lifetime.
Well, listen. If you had $100,000 and you left it in the market for 30 years, and you got 7% a year. At the end of that 30 years, it should be $761,000. If you take out 2%, just 2%, which is a low figure for fees, that gives you $432,000 at the end of the 30 years. You lost $329,000 to those fees. That's a
big difference.
That's a huge number that people don't necessarily consider. One of the great things about self-directing in an IRA, whether it's a traditional IRA or a Roth IRA, is you eliminate those fees. The other is that you have access to the assets we've been talking about, futures, Forex, options. You can't short in a retirement account. By the way, shorting is what a lot of the pros use in the markets to take advantage of a downward moving.
You can utilize options, though.
Yeah, you can use options. You can use these inverse ETFs, which go the opposite direction of the underlying. The other thing is that in the 401k or 403b, there is a match for most people, and that's free money. That's something that people should take advantage of, but you're still encouraged to keep putting more money into the 401k even after that match has been met. What a lot of our students do when they realize that they can self-direct is that additional money maybe goes into a self-directed IRA. Or if you are out of work now, if you leave a company for any reason, you can take that 401k and then transfer it to a self-directed IRA. That's what most of our students would do because they then have access to many more choices and they can take advantage of not just upward moving markets, but downward and sideways moving markets.
And that's the key. I mean, we hear a lot of, we have a lot of conversations with people coming into these classes and they just want to be able to sleep better at night. And being able to eliminate fees or at least lower them, that could be a huge difference over a case of 5, 10, 15, 20 years even. And I mean, we have a lot of listeners that want to understand more about self-directing. And I mean, the 401k, that's not a bad thing. It's helped people save. But if you're encouraged to buy more, let's just say every other Friday, you're buying with no plan of gain or loss at whatever price it's at. So, Al, in this last segment, I mean, these shows go by so fast, and I feel we have a lot more to discuss. We have listeners that want to get started trading and investing and don't know where to start. And it's not just as simple as putting capital into a brokerage firm and placing trades. Anybody can do that, but is that the right thing to do first? This is Josh and Al with the Retire Young radio show. We will be right back.